What's up? This is Doty Frades, and in this video, we are going to talk about putting up risk guardrails to help you from blowing up your account. And really, blowing up your account is the most common mistake people make, and the reason is they simply do not have the right risk guardrails in place. So in this video, we're going to go over a simple framework and mindset to help you have those guardrails so that you can stay in the game, which is the most important quality of successful traders. But before we dive in, let's do a quick disclaimer. Okay, let's go and dive in. Let's talk about what most people do when they get into trading. This is one of the most common mistakes that I see when it comes to traders getting started is they will want to start. They'll want to start taking action. Maybe they're trying to go long in a trade. Maybe this is Bitcoin. They see the market going up. They start to get in long, and eventually the market starts going down. They get stopped out, and maybe they got stopped out a few different times before that. Maybe they're trying to go short down here. They saw the market breaking lower, and then the market takes off to the upside. So then they lost another one, and so on and so forth. And sooner than they know it, they are down drastically on their account, or they've blown up their account. And the reason being is they just do not have risk management parameters. They don't know what to risk per trade. They don't know when to stop trading. They're just assuming if they see a setup, that means that they should take the setup. But you have to understand, not all setups are going to work. And a lot of times we're not getting in an ideal environment. But the biggest piece is most setups do not work all the time. And there's really no perfect strategy. So you need these risk parameters to keep you safe. So one thing I want to just stop and talk about really quick is there are actually, there's geometry and mathematics to how big of a loss you take to how much it takes to recover that loss. So let's just check this out really quick. So if we look at this chart here, you can see that actually we're starting to see just $1,000 balance. We're looking at the percentage loss after the loss and the gain needed to recover that loss. So this is the key one, percentage loss and the gain needed to recover that loss. So say you take a 5% loss on a $1,000 account. After you take that loss, you know that your account's going to be $950. To recover that account, you're going to need to gain not 5%, but 5.26%. Or if you lose 10%, you don't have to gain 10%, you actually have to gain 11%. Now, after 10%, things start to get a little bit tricky. At 15%, it turns into 17%. At a 20% loss, you now need to gain 25%. Let's just go up to a 50% loss. If you lose half your account, no, you don't need to just gain half your account back. You need to gain the entire account back to get to your balance. So if your balance is now $500 and you started with $1,000, you now need to gain 100% back. And it's pretty difficult to gain just 100% off the gate, right? Some portfolio managers would be incredibly happy to have 100% year, let alone 100% day, week, or month. So the key of this game is to keep your losses small. But if you don't have a plan on how to keep your losses small, that's when things get very, very challenging. So let's talk about what that plan could look like. Now, the first thing I'm going to caveat with is there's no perfect plan. The only thing that you can really know is your numbers. And that does take time, you know, knowing your average winning percentage, your average winner compared to your loser in terms of gain versus loss, etc. So you're going to need that data. But there is a place you can start even without that data, and that's just more conservative. A lot of us, we get into this game and we're thinking less conservative. Maybe we're not risking a lot of money, so we think it's not a big deal. But in the end, if you do not have these risk management principles, when you do have a big account, it's still going to affect you. So you might as well start early. So let's talk about it. So the different types of risk that you can think about here is, let's just go ahead and write some of these down. Let's make my font just a little bit bigger. Okay. Okay. So let's just start to dive into some of these. So we're going to talk about some of these risk guardrails. So we have the types of risk guardrails, and these are the things that people do not think about. For example, do you know how much you are risking on any given trade? Does it make sense to risk all of your account on every trade? Does it make sense to risk half your account? Does it make sense to risk a certain percentage of your account on a certain trade and a certain percentage of your account on a different trade? What is this risk per trade? Or even investment, right? These are a trade and investment are the same thing. Or risk per day. This is different, right? Well, if I'm risking, say, 1% of my account on a trade, and I take 10 trades and I take 10 losses, that's 10% of my account in a day. So it doesn't necessarily matter. I mean, it matters a lot on your risk per trade, but it doesn't matter if you take a lot of trades and lose, right? So maybe you want to cap in a day. Or then obviously, say you lose, say 3% in a day. What happens if you lose 3 days in a row? That's 9% of your account. So maybe you want a risk per week and risk per month cap. And then total exposure. What's your total risk? What's the most you're willing to risk of your capital? These are very, very critical to think about. So I'm just going to give you some industry guidelines. Now, please note that this is not financial advice. This is not to say to use these, but this is what is often used in the industry. And the best thing I can tell you is you need to understand what your risk tolerance is. So your risk per trade is the easiest one to understand what your risk tolerance is. And then you can do something that I call the toilet test. we could do what's called the toilet test. The toilet test means, what are you cool flushing down the toilet? Because the more you become more uncomfortable with that number, whether it's $5, whether it's $10, whether it's $100, $1,000, $10,000, if you can't afford to just flush that down, then you are tapping into not your risk capital, right? You're tapping into your actual needed capital, which was probably for your rent, your living expenses, food, water, shelter. So if you can't flush it down the toilet, you're probably dealing with money that is not your risk capital. And even if it is your risk capital, what percentage of that capital will actually keep you in the game? So often traders use, at least from what I've seen, often traders use around 0.25 to 1% of their risk capital, of the capital that they are already willing to risk. So this means, if we give an example, if we have a $1,000 account and we're risking 1%, how much would that be? So all you do is type in 1,000 into your calculator times 0.01, or if you have the percentage button, you can use that, but that's going to equal $10, right? $10. So the question is, if, compared to your capital size, would that, say, 1% make sense? Or would you want to go lower than that? Would you want to maybe go to 0.5% or 0.25% or even lower, right? Obviously, the lower, the more conservative. So the question is do you have that risk per trade? Now, if you're taking this kind of general standard, let's just say we're looking at 0.25 to 1. Actually, sometimes traders go further than that. Maybe they do 0.25 to 3%. It just depends, right? I would say on average, from what I've seen, it's around 0.5% to 1%, but that's just from what I've seen. And again, there's no golden answer until you have your data, but I would say start more conservative than less conservative. But let's say we are looking at 1% of the account. It's going to take a lot of 1% to really do crazy damage to the portfolio. I mean, you have to lose 10 in a row to lose 10% of your account. Now, of course, 10% is tough. You have to gain 13% back, but that's not 100%. So these are the things that you have to think about. You know, a lot of people, they put their entire account on a trade, and say in crypto, stop losses are easily around 20%. So you could say, you know, if you lost 20% in one trade, that's obviously much more significant than losing 1%. Okay. So start to experiment with what that is. Okay. And if you get that percentage, let's just use a very simple one in this example. Let's start to use that 1% again. 1%. Let's start to think about the risk per day. So if I'm risking 1% of my account on a given trade, and I take 10 trades, like I said, and I lose all those, that's 10%. That's a pretty significant amount of the portfolio, right? How often do you have 10% gains per month? Maybe you're some sort of wizard trader and it's all the time. Or if you're quite normal and it's not that often, you know, that's a pretty decent month, 10%. So you have to have a decent month if you lost 10%. And we're talking about a day. So let's think about that. You know, what if we just lost 2 of these in a day? So that would be 2%, right? That'd be minus 2%. What percentage could that look like? I'd say some of the industry, you know, averages I've seen for this is, you know, around 0.5% to 3%. That's what I've seen. Again, it's not to say this is yours. You're going to have to know your number. But if you start to add these up, say we have that 1% rule, right? We're using 1%. We could lose 3 of these. We could lose 3 of these and then know that we have hit our upper limit, if that's the case. Or if you lose 1, you know you're already halfway there. Okay, so these are things that every trader that I know, they have these written down. And then risk per week, risk per month. You know, I can never give you exactly what these are, but you know, it might be a risk per week. Maybe it's going to be risk per month, maybe 6%, 4 to 6%. Who knows, right? You're going to have to figure that one out for yourself. Everybody has a different risk profile. But say you had a bad month and you're down, say 4 to 6%. Is that going to kill you, right? Is that going to be hard to recover? You're going to have to understand your numbers. If that's in something that's like moderate, but totally recoverable, maybe that's a good percent, right? But if this is, you do not lose, you know, you do not gain 4 to 6% on average month over month very easily, then this is obviously too high. Like I said, more conservative the better, the more you know your numbers. But the key is not to blow up. Most people are losing 100%. Literally 99% of people are losing 100% of their account or close to it in a week or a month. So if you're at 4 to 6, even if that's too high for you, you're way better off than being the majority that is closer to that 100%. Okay. Just put question marks here to know that these are not set in stone. This is for education, right? And then total exposure. What is an amount where you, if you lost it, you'd be like, you know what, I think I should go back to the drawing board because I need to figure out my strategy. I need to refine things. Maybe the market conditions are not in my favor, but also it is recoverable, but maybe a little bit more of a slog than at your month exposure, or maybe it's the same. You know, let's say it's 10%. Okay. And remember, most people are going to think about their strategy and what they're doing right or wrong once they hit, 90% plus in a loss. That's when they're typically doing it. So if you're at 10%, let's say that's the right answer, it's a heck of a lot less than 90%. And 10% is a decent chunk, right? If you made a 10%, you made essentially the return of the S&P 500, but essentially that's what you're doing here. If you just said, you know what, I'm not going to trade anymore actively, I'm just going to go passive, 10% is your passive rate on average for, say, the S&P 500 index. So a passive strategy could get that back in a year. That could be a way to think about it. Or again, know your numbers. But most people will say, you know what, I need to think about my strategy way, way, way worse off, say 90% plus, than 10%. Okay. So what I want you to think about is, what are these guardrails? Imagine trading with these guardrails. Imagine making this super conservative. Imagine you lose 0.25% of your account on a trade. Are you worried? Is that a challenge? Or is that going to be something, we probably spend way more than 0.25% of, well, let's just, of our income during a month or a day sometimes. So if you're looking for an opportunity specifically, is 0.25% of your account, is that worth a potential opportunity? Is 1%? But most people think 100% is worth it. Likely not. And if maybe you'd, on a bad day, your maximum risk in a day, if it's 1%, is that something recoverable? Or maybe 0.5%, is that something recoverable? Or on a week or on a month, if it's a really bad week, if you lost 4% of your account, yeah, that's probably going to suck if you're really, really into this stuff, right? But decently recoverable. And most people, remember, and if you've been trading at all, you're probably, and you're still new to this, you're probably way above this. And that could be a huge reason why you're not seeing the results that you're looking for, because the main thing, the only thing that we can control as traders is our risk management. And then total exposure. What's that cutoff point where you need to get a mentor, you need to evaluate your strategy, you need to really sit down, pen and paper, look at the numbers, and take a little bit of time to make sure that your trading strategy is correct. What percentage is that? So hopefully that was helpful. I think this is a very important lesson when it comes to this stuff. Let me know in the comments if you have any questions. And remember that there is no right answer to this. If you had a 90% accuracy strategy, obviously that would make your ability to risk go up. But the problem is most people have nowhere close to a 90% accuracy strategy, nor do the pros, nor do you need to. Most professional traders that I know have around a 50 to 20% win rate. Okay. Also, it depends how big your gainers are to your losers. If you only gain a little bit but lose a ton, that's a big difference than if you gain a lot and only lose a little. So let me know if you guys have any questions. Hopefully this was helpful. If you do need more help with this, definitely join my free community. I'll put the link in my bio, and we'll take it from there. But I appreciate you guys watching. And this, like I said, is the #1 challenge of my students right now. So I wanted to go ahead and make a little training on this. All right, I'll see you guys in the next training.